I'm Marella Fernandez. Welcome to Market Call. Thanks for joining us today. Jamie Murray is with us, portfolio manager and head of research at the Murray Wealth Group. He'll be taking your questions on global equities. You can call us toll free, 1-855-326-6266. And if you want to send an email, you can do that at marketcall@bnnbloomberg.ca. Jamie, thanks for coming in today.
Yeah, thanks for having me on.
We had first quarter reports from two banks today, BMO and Scotiabank. Both of them beat expectations. What's your take from the banks today?
I mean, I think we've seen strength in the U.S. market. That's not really surprising, but certainly the market's rewarding BMO for that strength. There was a little bit of outperformance there. And the Scotia numbers were strong as well, but I think we're starting to see investors start to look at the geographic segmentation of all these banks and saying, the guys who have bigger U.S. presence, we feel more comfortable in these banks versus some of the more Canadian domestic banks.
Yeah, for obvious reasons. Donald Trump has been threatening the tariffs for a while. We're now closing in on the March 4th deadline, which is that first round of basically wide 25% tariffs from Donald Trump. Are you seeing any sign of uncertainty in the market?
There's obviously tons of uncertainty. I think nobody really has a good understanding of what is actually happening. Are tariffs going to be implemented on which goods and which sectors? And we've heard mixed things. Obviously, the president will say what he's going to say, but then we hear through the back channels that, well, we're not really ready to put tariffs in, or it's not going to be a widespread. And certainly, we're seeing like some Canadian auto parts stocks. They've been weak, certainly, but I think Linamar was up this morning, and that's a stock that you would expect to be under more significant pressure if there was really a fear of tariffs being implemented in a week.
How are you advising investors at this time, given everything that's going on south of the border and the trickling over?
Well, certainly you got to stay diversified. Don't put all your eggs in one basket. In both of our funds that we run, we obviously try to avoid too much concentration in certain sectors, and also looking at where are the opportunities in a weaker market. And so that could be real estate. Some stocks that are in sectors that are more interest rate sensitive. Certainly, we think interest rates are going to head lower. And so that will have some opportunities as well.
Okay. I know that you have noted that housing supply is up, which we have seen, not as many buyers, but housing supply is up. And you've noted as well that there's some challenge in employment numbers. So are these trends, do you think, going to play out on the markets?
Yeah, and I think we're starting to see the market start to sniff that out. And we've seen certainly the U.S. 10-year interest rate bond yield fall significantly in the last couple of weeks. And yeah, the housing side on the U.S., I think there's more homes available for sale in the Sunbelt states today than there was in 2019. And we haven't seen prices react to that. We haven't really seen home building levels come down too much. And we think that we'll start to see that more significantly play out through the spring. And that's just going to put more opportunity for the Fed to ease going into the back half of the year. Okay.
We've talked a lot about tariffs, but there is also an expectation from Donald Trump that there will be deregulation, there will be incentives for businesses to move to the U.S. or to prosper in the U.S. I'm just wondering if you see investors benefiting in some way from that.
We do think that the deregulation is going to play out. We think that's more of a 2026 story. It's going to take them some time to figure out what regulations we need to remove. Where's going to be the most bang for the buck? And it seems like the Trump administration right now really is focused on the tariff side, and then they have the government efficiency side where they're laying off lots of staff. And that's going to have, we think, negative economic consequences in the short term. And so really we think this market is going to be a little choppy for the next, call it 4 to 6 months. But then we think as investors start to look out to 2026, rates come down, some of those deregulation effects come into play, and then we'll see companies start to invest again. Because again, it's hard to invest when you don't know what the policy is going to be, and that's been the main issue with the Trump administration so far.
It's almost paralyzing because you don't know which way to go.
Exactly. I mean, we've already heard of companies adjusting their plans in anticipation of tariffs. And then if that doesn't actually play through, then you're in a weaker position than you would be otherwise. So it's just a lot of uncertainty right now on that front.
Got it. We are going to take a quick break. We'll be back with Jamie Murray. He's a portfolio manager and head of research at the Murray Wealth Group. He's going to take your questions on global equities. Here's how to reach us today. We're back in a moment. Welcome back to Market Call. We are going straight to your questions today. Our first email question comes from Skip in Ajax, Ontario. He says, could the guest comment on Netflix and would he buy here? Netflix has done very well. Yeah,
Netflix is a great company, and thanks for the question, Skip. So Netflix is a name that we've owned in the past. We bought it up fairly significantly a couple of years ago when it was really selling off hard, when there was concerns that there was too much competition in direct-to-consumer TV. And we saw Amazon Prime and Disney Plus launching. So that was really the opportunity, we think, to buy it. And now it's just really been a momentum story. And it's had great momentum, great investor returns over the last couple of years. It is getting a lot more expensive. So it is a name that we've sold out of in the last year. We just think there's better opportunities in technology, particularly on the Gen AI side. But you can't argue with what Netflix has done. And I mean, it has a very strong outlook. It's just a little bit more expensive than we typically like to hold.
Yeah, and historically, when they raise prices, people would push back against that. They didn't like it.
Yeah, exactly. But we've seen that over the last couple of years that the price increases have come through. And they've done a really great job, particularly on some of the live programming, which 5 years ago, they said, we don't want to get into sports. It's not really our thing. And now they've had great success with that, with some live boxing matches and the NFL. It's just been must-watch TV for those consumers. And so they're just looking for more ways to attract and retain subscribers.
Got it. That is on Netflix. Let's go to the phone. Deborah's on the line calling from Okanagan Falls in BC. Hi, Deborah.
Oh, hello. Marilla, first of all, I'd like to say congratulations on landing the Market Call spot. I really look forward to you asking some challenging questions to help us with our investment decisions.
Thank you very much.
Yeah, Jamie, so my question today is on UnitedHealth Group. There has been another stock drop with the DOJ, I should say, investigating the Medicare billing practices. I'd like your thoughts on this and your feedback on whether you think this is an entry point, and what are the analysts saying on this?
Yeah, thanks for the question, Deborah. So we think UnitedHealth is at a buy point right now. This was actually a top pick of mine on a Market Call episode in the spring of 2024. So I liked it then. It's kind of back at the same price. As Deborah alluded to, there's some government investigations into their billing practices. We actually don't think there's going to be much of a negative outcome from that, but there's certainly headline risk, and it might be hard for investors to step in during this time period. But ultimately, if you look back at the fundamentals, they're all improving the right way. The big knock against them in the last year was their medical costs were way too high. And so as an insurance company, they were having to pay more than they wanted to for doctor and nurse and procedures payments. And so we're starting to see that normalize. And the valuation, it's trading below the market multiple. Typically, this trades at or above the market. It's a leader in the sector, and the fundamentals are moving the right way. So we think I would use this noise as an opportunity to buy the stock.
Okay, and just to repeat, you don't think much is going to come from the investigation by the Department of Justice?
Yeah, we think, it's a very well-run company. We don't think that there's any wrongdoing there, but obviously we'll have to see what plays out. But yeah, we're not. Our base case is not that there won't be much in the way of that.
Got it. Let's go back to the phones. Rob is on the line from Calgary, Alberta. Rob, hi. What's your question today?
Hi. Thanks for taking my call. I just realized that today's program was focused on global stocks, and although this company has global aspirations, their business is focused closer to home. So I hope you'll indulge me. I'm a long-term holder of Quarterhill on the TSX. In my opinion, the stock has underperformed, and I'm just wondering, Jamie, if you see a catalyst for change, or should I cut my losses and move on? Thanks again, and have a good afternoon.
Thank you.
Yeah, thanks, Rob, for the question. So Quarterhill is it's a company I'm familiar with. We own the convertible debentures of Quarterhill in our income growth portfolio. It yields around 6%. And then it gave us the upside optionality if Quarterhill stock had a little bit of a run. We could convert that into equity and get a nice payment. So that's how we've been playing the stock. It was a good story, and I think it still could be a good story, but it's just really been stuck in neutral. Quarterhill is a company that sells technology to governments for highway infrastructure and toll roads and such, way station infrastructure.
Okay.
And so it's very contract-based, very lumpy in terms of sales and revenue growth, and it just really hasn't come through the way that I think investors were hoping to when they started focusing on the strategy a couple of years ago. But we're still along the debentures. We'll let those mature in 2026. There's a pile of cash on the balance sheet that the company can use to redeem that and make acquisitions. So, I think the revenue will continue to grow as they do these acquisitions, but it certainly hasn't played out how investors wanted it to.
But it's worth holding on to.
I think you could hold it. I think the thesis is still there. It still is the automation of highway technology, and particularly as we move into autonomous vehicles and autonomous trucking, you might see more opportunities in this market. But it's certainly taken longer to play out than we hoped.
Got it. All right, let's go back to the phone lines. Henry's on the line from Vaughan, Ontario. Henry, what's your question for Jamie today?
What's your long-term view on British Petroleum? Do you think it's bottomed out and headed for a turnaround? Thank you.
Yeah, thanks, Henry, for the question. So BP, it's a stock that we actually own in both of our funds, in our global equity and our income fund. It's our thesis on it. It's really just the cheapest of the major oil companies, and in 2022, 2023, they were doing a good job buying back stock. It had a very nice dividend yield. They were increasing the dividend, but really they just let the debt get a little bit too high over that time period, and then as energy prices softened, they've been sort of caught offside. The debt's not a long-term concern, but in the short term, they've had to focus efforts towards repaying debt. But we like what the new management team's doing. There's a new CEO who was installed, who was actually the old CFO. They're doing an investor day, I think, this week or next week, where they're going to have a new long-term update. They're definitely shifting back towards more higher return oil projects. There's an activist investor in there as well, that Elliott, that has had good success turning around underperforming value stocks like BP. And so we think there's going to be some asset sales announced. The debt's going to come down, and I think they'll have a more focused strategy going forward. So there's still opportunity there for the stock to re-rate higher.
Got it. All right, we're going to be back with Jamie Murray. He's a portfolio manager, head of research at the Murray Wealth Group. He'll be taking your questions on global equities today. We're back in a moment. Welcome back to Market Call. Thanks for joining us today. We want to get right to your questions. Margaret is on the line from Sarnia, Ontario. Hi, Margaret.
Hi, Marilla. I, too, would like to say what an excellent job you're doing. I'm really enjoying you.
Thanks very much.
My question today is on Nvidia. I'm 77. I have some in my TFSA, and I'm still in profit. But they report tomorrow, and it's just been continually dropping. I'm wondering, should I take my money and run, or wait till they report tomorrow and see where things end up? Thanks so much, Jamie. Bye-bye.
A lot of crossroads for people with Nvidia, I imagine, especially with that report coming out tomorrow.
Yeah, it's obviously the most topical stock. I was at an analyst lunch about a month ago, and it was the only company out of all the semiconductors that there was anybody wanted to talk about. So Nvidia, I mean, calling the quarter is a very challenging thing. There's everyone, thousands of analysts looking at this and trying to predict what's going to happen. I mean, all I can say is we still see a very strong demand picture for the next year to 18 months.
Okay.
Nvidia is still just ramping up their Blackwell, their new generation chip. From what we understand, it's pretty much sold out into 2026. There has been some noise in the last week around data centers, Microsoft canceling some leases or postponing some leases. And so that's just, we don't think that's anything long, medium-term concern, but certainly the market's looking at these data center build-outs, and if there's a slowdown, what does that mean for Nvidia?
And Nvidia down today as well a little bit.
Yeah, and I mean, the stock, though, on a valuation basis, it's back to about 25 times EPS if you look out a couple of years. And I think there's some concerns that Nvidia is going to be like the Nortel networks of this current AI bubble, where it's going to go up and then just go straight down. But we don't see that being the case. Like, we don't own it. We own Broadcom, which is another company in the AI chip race. But about 60 to 70% of these chips that they're selling this year are going to need to be replaced in 2, 3, 4 years when new generation chips come out. So even though there's a lot of demand now, there's going to be a big replacement cycle for a lot of the current spending. Nvidia, long term, I still think it can do well from here. But certainly calling the quarter on a one-day thing, there's high expectations, and that's not the game that we typically play.
I didn't realize that the chips would have to get replaced that quickly.
For sure. I mean, companies want to stay competitive, and Nvidia is going to keep innovating and keep releasing new versions of chips, as are their competitors. And so, you'll see that generally 3 to 4 year replacement cycle, I think, for data center products is pretty typical. And so Nvidia is going to have another wave of demand coming at them. It's just really how big does this first wave get to be?
Got it. All right, let's move on to our next caller. We have on the line Mario, who's calling from Mississauga, Ontario. Hi, Mario. What's your question today?
Good afternoon, and thanks to take my phone call. And my question is about Toronto Dominion. I would like to get the 5% of my portfolio, and I would like to hear something about. Thank you very much to take my call again.
Thank you. Toronto Dominion, we've had a few questions about Toronto Dominion since it's taken a dip and people want to know whether they should dip in.
For sure. So Toronto Dominion TD is actually a stock that we've acquired in our Global Equity Growth Fund just in the last year. And actually one of my past picks we sold out of to get into TD over the last 6 months. We've been sort of scaling into it. So we think this is a good opportunity to acquire one of the best banks in Canada. It's trading at a significant discount to Royal Bank. I mean, that discount's justified in the fact that TD is going to be limited in their U.S. growth, which, as we were talking about at the top, is where banks currently are seeing the most success. But we don't think they're going to be so constrained that they're not going to be able to grow their earnings per share, grow their dividends. They've already announced a couple of transactions to shore up the balance sheet, reduce their capital so they can shrink it to then grow it back up to the asset limit that the U.S. regulators imposed, given the challenges they've had there. And, I think the new CEO who they brought in, there was an RBC CEO bank conference in January, and he was the star of that conference. And so I think you have a fresh voice, fresh perspective in there, and the valuation's right. I think the dividend yield is around 5.5% today. That's a good level, we think, to get into TD Bank.
At the end of the year, it was down to 73.50. It's now up to about 85.30, 28. Still good to dip in even at that number?
Yeah, certainly it's not the same screaming buy as it was at the end of the year. And again, owing to the new CEO coming in, they've already accelerated a couple of strategic transformations, like selling the Schwab stake that they had. And so they're taking swift action, and again, we think their banking operations are still very high quality in Canada and the U.S., and they'll find ways to grow the earnings.
Okay, sounds good. Let's move on to Fred, who's calling from Burlington, Ontario. Hi, Fred. Do you have a question for Jamie today?
Yes, thanks for taking my call. Tamarack Valley. I'm looking at the results here that just came out this morning. And per share diluted, it says 1 cent, and of course the stock has dropped by about 20 cents today. And I'm wondering just exactly what's up.
Energy company?
Yeah, energy company. Oil prices are weak, and so we've seen weakness right across the board with energy stocks today. And that's always going to be the short-term driver of an energy stock, is which way the oil price is moving. But you can see it's had a pretty nice run over the last 6-7 months. Tamarack, they did some acquisitions. The debt got a little bit too high. Investors wanted them to bring that down. They have, and now they're refocusing on their higher return plays. They have a really nice play in the Clearwater play, very high return. They have a long-term inventory base that they can continue to drill out. And so for a junior mid-cap oil stock, I think this is the one that we'd play. We own in some private client accounts in our firm, but it's not in any of our funds.
Got it. All right, we're going to take a quick break here on Market Call. Back with more of your questions and Jamie's answers in a moment. Time now to take a look at Jamie's past picks. We will start with the picks from February 2024, February 16th, so just a little over a year ago. We'll start with 3i Group, ADR. And Jamie, you're going to have to explain, first of all, what this one does as we take a look at the numbers on the screen.
Yeah, so 3i Group is it's a UK private equity investment company that about 13 years ago, the current CEO said, we're not going to do traditional private equity, which is taking third-party capital and investing it in funds and trying to take a management fee. They said, we're going to take our own capital and then buy companies, and we'll try and earn a 15-20% return on buying and flipping these companies over a 5-year period. What happened around that same time, they made an investment in a company called Action. And Action is a European discount retailer. 3i owns about, I think it was around just over half the company as of their last report. And Action has turned out to be one of the great retail success stories globally, but definitely in Europe. They've gone from a few hundred locations in that time period to now almost 6,000 locations across Europe. We think Action can grow to be close to 10,000 locations. And then they're looking beyond Europe. They're looking to Southeast Asia, potentially even the United States to expand this Action platform. And really, it's just all about growing that store base. They get big synergies on buying discounts the larger and larger they get. So it's a very good model. They like to pass cost savings back to consumers. And so Action makes up about 75% of the value in a 3i share. Okay. And so most investors, ourselves included, own 3i Group for this Action retail holding they have. And as long as Action continues to perform, we think 3i Group will continue to do very well. So
it's almost like a Costco, but on a smaller footprint for individual stores?
Yeah, that's a good way to frame it. Costco, of course, has like the membership model, where this is more, I've used it almost like a Dollarama type model.
Walking off the street.
Yeah, and when I said that to the CEO, he said, we're not Dollarama, don't call us Dollarama. They do sell higher value items.
Okay.
But definitely it's a large, they sell items on a SKU basis about a 30% discount to nearest competitors. So very, very, lots of value for consumers. 68%
value there, total return in that time. Okay, let's move on to AstraZeneca, which was a topic for you as well. At the time, about a year ago, it was 64.27 American, now sitting at 76.14. So a return of 18%, 23% when you add in dividend for total return. So it's also done well. And we all got to know the AstraZeneca name, of course, during the pandemic.
Yeah, exactly. And AstraZeneca, their big products actually are in immuno-oncology, so some new cancer treatments. There's some new products that they've launched that there was a lot of excitement around. If you look at the one-year chart, you can see it had a big run through last summer, getting up over almost to the $90 level. And then a couple of headwinds have happened since then, which they're starting to now recover from. One of their cancer drugs didn't quite perform quite as strongly in the trials as they expected. And then the second part is they actually had an investigation into their Chinese business, which is a large business for them. But we think both of those are starting to clear. There's been a lot of clarity on the Chinese investigation, and it seems like it's pretty much a non-event going forward. And then they have this huge pipeline of new drug opportunities. We think that this is going to be one of the best growth stories in the pharma space, and it's trading just around a 15, 16 PE multiple, so lots of value. One that we still own a very large weight in our global equity growth fund. Okay, so the return was 18%, the total return at 23%. Let's go on to Manulife, which was your third pick from 2024 in February. $33.30 at the time, and now up at $10, just shy of $10. A return of 30% or 36% in the total return. What's going on with Manulife? Yeah, so if we flash back about a year, 18 months, Manulife was still dirt cheap. It was trading at like a PE ratio, price to earnings ratio of about 6 or 7 times. Lots of investors thought it was left for dead, just a sleepy old insurance company. And they had some bad insurance contracts signed from almost going back to the financial crisis. So some very bad insurance contracts that was taking them a long time to work through. And then in December 2023, they were able to offload a chunk of these contracts at a very nice price. And we looked at that and said, hey, if Manulife's able to sell all of these sort of worse, poor performing policies at book value, which is what they sold it for, that's going to be a huge re-rating opportunity for the stock, because then the stock should trade at close to 10, 11 times more in line with peers. And that's what played out. And so when I said we sold a name to cycle into TD, it was Manulife that we sold. We still think the company's doing well. Their last earnings report showed more progress on that front, but we just saw more upside in TD, and so we've exited Manulife around the current price. Okay, so up 30% is what we have there. So pretty good for a year's investment. For sure. Okay, we are going to take a quick break. We're going to be back with Jamie Murray. He's taking your questions today. He's portfolio manager, head of research at the Murray Wealth Group. Your questions today on global equities. Back in a moment.
Thanks for joining us here on Market Call. We have Jamie answering your questions today, and we want to go straight to the phones. Mark's on the line, calling from Ottawa today. Mark, what is your question?
Hi, Jamie. Thanks for taking my call. I like investing in banks through the COVID recession, through the financial collapse 2008. Canada had great regulations. We came out pretty much unscathed. The bank did, and the economy in general because of it. In the U.S., it was a much bigger disaster. Now, everybody seems to be very excited and cheerleading for removing regulations and consumer protections. I'm just wondering, where do you hide out, and how do you see this as a factor? I mean, the big monopolists are going to buy out little ones, eliminate competition. They're going to have predatory practices. It's all going to come out as a narrative after the current yippee, we're happy about the regulation narrative. So where do you hide out in this? What do you do? Or is that not a factor?
Yeah, so obviously, banking deregulation is one of the areas we're probably most excited about in terms of what the Trump administration could actually do. And again, it's always things always get pushed too far. In the financial crisis, we've all heard the stories about what banks were doing and the risks they were taking, and very irresponsible. And that's why Canadian banks generally are a bit of a staple in our portfolios and a lot of other investor portfolios. Is through thick and thin, they usually emerge. We'll say a little bruised, but not beaten.
Relatively
unscathed.
Yeah.
I think Bruce, our CEO, likes to talk about how he's seen some U.S. banks like Citigroup go bankrupt twice in his career, and will happen a third time. I mean, who knows?
Yeah.
But so certainly in terms of the U.S., though, what we've seen, lots of capital constraints were put in following 2008, and just loosening those will just free up a ton of capital for financial companies. And that'll be good for lending, good for ROE, good for profits. So that's the short term. And so Morgan Stanley is a name that we own in the States for that.
But do you fear, as obviously our caller does, that there will be too much lifting of restriction, too much freedom, and that some of these larger banks even could push you too far?
So do I fear that? I think it's just always about being wary of where you are in the cycle. Almost any cycle, and certainly banks have, different industries have predatory ability in that sense, but it's always just being wary of where you are in the cycle, and when trying to look for those signs when things are getting pushed too far, and knowing that there's usually a time to exit a trade or an investment when that happens.
Okay, out of curiosity, what do you look for? One or two things investors could watch for?
So, I mean, a lot of it is capital that starts chasing returns. So when capital is leaving a sector, that's when we start to look at it. So, I mean, real estate's a good example of where we're starting to see money get pulled out of, and we're starting to get a little bit more excited about, particularly with the good fundamentals in some asset classes. And then concurrently on a more recent example, so on the AI building, we're now seeing SoftBank come in with huge commitments for money. And, we'll eventually probably see other private equity companies. When you start to see those financial players putting large amounts of capital, and that's when you're starting to see the returns get diluted down. Because it goes from being a business case to just a financial case. And that's when returns start to fall.
Got it. All right, let's get to our next caller. We have Perry on the line calling from Toronto. Hi, Perry.
Yes, hi. Thank you for answering my phone. I just wanted to ask Jimmy that last week, one day was that one of the banks was upgrading Celestica, and then goes higher. The next day it started to come down and down and down, and this is Canadian for Canadian. American doesn't need, because they have lots of companies for chip makers. I don't understand why it came down this much. Thank you very much.
Celestica.
Yeah, well, so Celestica has been a very active and volatile stock over the last year. Great performance, great returns. It was a sleepy, one of the sleepiest stocks in the index for the last decade. And then it's benefiting from this AI build out. So Celestica works with Broadcom. So again, a company that we own and like to package Broadcom's chips to sell to hyperscalers. So Google wants to buy, Alphabet wants to buy chips from Broadcom. Broadcom will work with Celestica to package that chip into a box that can be put into a data center. So Celestica is benefiting from this huge demand, but it is, as we talked about, I think as well, that we're seeing some slowdowns potentially in the data center build out, and the stock's just reacting to that. It's really it's trading up on days when the outlook looks better, and then any negative news, it's selling off on that. Ultimately, we're going to see the revenues increase over the next 2 or 3 years, regardless, and it's really that outlook into 2028, 2029 that's really going to drive the next leg of this company.
Got it. All right, let's move on to our caller, Ian, calling from Kingston, Ontario. Ian, do you have a question today for Jamie?
Yes, Alphabet, specifically Waymo. These cars seem to be working. I've been watching the TV, and these cars look like they're making money. Why don't they have the same market cap as Tesla? Like they're almost $1 trillion, and Google doesn't have much money coming from Waymo in terms of market cap. Also, now that Donald Trump's elected, do you think the DOJ will be laying off Alphabet? Thank you.
Yeah, so thanks for the question. So a couple in there. First off, I would love it if Alphabet got the same valuation as Tesla. It's our largest holding in our global equity growth fund, so that would be good for us and our investors. But
why doesn't it? Why doesn't it get the same attention?
Well, so I mean, Tesla, just at least Tesla's a bit of a cult stock. The hype is it's not the cars, it's the future that they're selling with Tesla, and so. And that's why you'll see it go up 10%, and then today Tesla's down 10%, I think. So you're going to get that with Tesla. But with Alphabet, Waymo is a great product. We see this being one of the pillars of growth for the company. There's still questions around how they're going to monetize. Is Alphabet going to own all the Waymo vehicles? Are they going to start to license the technology? Are they going to sell it to fleets to put on ride shares? Are they going to sell it to people to use at home? So there's lots of questions, but certainly they're the leader in autonomous right now. And you're right. I was in LA a couple of months ago and saw a few cars, no driver driving by. People love the technology. And so that's just one pillar, though. I mean, it still is a large company. And the big concerns are the DOJ. They're actually found guilty in the court. So it's more about the remedies that are going to be put in place and what Google and Alphabet will need to do to satisfy those remedies. And then on the second part, there's concerns that their search moat, so the Google search moat, which is a large proportion of their profits, is being chipped away by OpenAI and Facebook, Meta. So it's really going to come down to how that holds up, plus what these remedies are. That's going to drive the stock over the next 12 to 18 months.
Is there any factoring in of the politics of that side, which is Donald Trump? He loves these companies, right? He loves his tech companies. And when something goes against him, he always pulls it back.
Yeah, and I mean, I think having Elon Musk in his ear Elon's going to argue for what Elon wants, which always isn't necessarily what is good for other technology companies. So it is hard to handicap, but certainly, and more broadly in Europe's been a little anti-big tech for the last decade. Is Trump able to put some pressure to ease regulations there? That could be good for them, but there's so many puts and takes. But ultimately, Alphabet's the lowest PE stock in the Mag 7. We still think it has one of the strongest moats. Like, we're not as concerned about the search business being eroded, and so that's why we own it, and we'll continue to watch that.
Got it. All right. We're going to be back with Jamie Murray. He's a portfolio manager and also head of research at the Murray Wealth Group, taking your questions today on global equities. We're back in a moment. Welcome back, and thanks for joining us here on Market Call. We go straight to the phone lines. John is on the line and holding on to talk to Jamie. He's calling from London, Ontario. Hi, John.
Hi. Hello, Jamie. The S&P 500 and Dow and NASDAQ have fallen for the last 5 trading days. I'm always interested to see which stocks don't fall when there's a general pullback. Celestica and Palantir have done that, and now until recently, and now Eli Lilly is doing it. They're up all 5 days on the pullbacks. What do you think of Eli Lilly as an ad right here? Thanks very much.
Yeah, thanks. We were actually talking about this very name in our investment meeting this morning. We own about 1% of our global equity growth fund is in Eli Lilly. We really like the growth profile. They have rolling out their weight loss drugs, the GLP-1s, and we think their products best in class and are going to continue to take market share from Novo Nordisk. And of course, this week the big news was that there's no more shortages, which was allowing third-party pharmacies to come in and it's called compound pharmacy, make their own make your own Ozempic and make your own Zepbound, which is Eli Lilly's product. So that's good that those shortages are gone. They announced a lowering pricing as well. And this is just going to drive adoption further and further. As you look, it's an expensive stock. When you look out to 2028, you're still only looking at $40, $45 per share in earnings. So that's still a 20 PE on 2028 numbers, which is expensive for a pharmaceutical. But we think they can keep their lead in the GLP-1 space, and that'll continue to drive the stock higher. But it's had a big run. It's not one that we're necessarily adding to. We're more trimming and maintaining it.
And pharmacists are no longer allowed, technically, I guess, to remix these compounds to create the same drug. Yeah,
once the shortages, it's a FDA, I believe, definition if there's not enough out there for patients. So that's when they're allowed to make their own. But so once the shortages is officially ended, then that becomes the Eli Lilly patent takes over again, and you can't infringe on that.
Got it. All right, let's go back to the phones. Joe is on the line. He's calling us from Woodbridge, Ontario. Hi, Joe.
Hey, Jamie. Thanks for taking my call. I have a significant position in NPI. I know they're announcing their earnings tomorrow. I was wondering what your thoughts are on the company. And also, do you feel like it might be a takeover candidate? Thank you.
Yeah, thanks for the question, Joe. So on Northland Power, it's a name that we've recently added to our income fund in the last 3 to 6 months, around the $20 share mark, so a little bit higher than where it's trading today. It's up 5% today. I think on that optimism of not necessarily a potential takeover for Northland, but one of their peers, Interjex, was just taken out at a huge premium. And so I think investors are starting to revisit the value that's in Northland Power. We think there's at least $25, $26 per share of asset value when you roll up all their projects and look at it on NAV basis and NAV basis. And really, it's just about how are they going to grow? How are they going to finance their growth? So they brought in a new CEO, we think very well respected she was at Atkins Realist, has experience with some other international energy companies. And we've just heard good things about her. She's on C&Q's board. Her name's Christine Healy. So tomorrow is going to be her first day to really reach out to the broad investment community. She just started, I think, a month ago. And that's probably going to be what drives the stock over the next couple of months. But certainly, we see lots of value in Northland Power.
Got it. Let's get back to the phones to get one more quick call in from Paul, calling from Chilliwack, BC. Hi, Paul.
Hi there. Mike, I have a couple of questions on Gibson Energy. One to do with the tariffs. Will they be affected? And the second, they do pay quite a high dividend. Just wondering if it's sustainable and where the stock is going from here after the recent earnings report. Thank you.
Yeah, thanks for the question, Paul. Gibson Energy is one of our larger holdings in our income fund. The stock has had a rough week, rough couple weeks. You can see falling from the $25 level down to $21. There's two real parts to Gibson. One's the infrastructure side, which is storing oil. So they have lots of oil storage tankers near the oil sands in Alberta. And then they purchased a shipping oil crude shipping port in Texas a couple of years ago, and that's the other side. And then they have a marketing business that sells and buys and sells products and tries to earn a spread on that. And it's really that marketing business that's been the weak point in the last couple of months. And that's a very volatile business. Some years you have good years, some years you have bad years. We're in sort of the lows of that business right now. But going back to the dividend, we think it's sustainable. Just on that infrastructure side alone, they generate more than enough cash flow to easily cover that dividend, to grow it, to buy back stock. And there's more demand for this type of service going forward as energy production grows. So yeah, we own Gibson. We're not worried about tariffs as it relates to them, and the dividend's sustainable.
I was going to say, is it the tariff situation that has caused it to plummet from January to February?
Not so much tariffs. No, it's more just some of the pricing. They look for spreads at different products, so they want to be able to buy this product maybe in this market and transport it or sell it on the other side and earn an arbitrage spread. And those opportunities, sometimes when you're in weaker markets like we're seeing now with oil prices a little bit depressed, they're not able to find those opportunities. And so that's been the main driver in the last month or so.
Got it. All right, that is all the time we have for your phone calls today, but stay with us. Our guests will share their top picks. That's coming up. All right, time now for our top picks. Jamie Murray is at the desk, and he shares his top picks with us right now. The first one being Starbucks, which has been in the headlines quite a bit lately because they're trying to retool to, I guess, make their line more efficient, get to customers quicker. So that's one of your top picks. Why is that?
Yeah, so Starbucks, the thesis really boils down to they made a CEO change last summer. We think they went from one of the poor management teams in the retail sector to maybe hiring the best quick service CEO in Brian Niccol. So he came over from Chipotle Mexican Grill. In 2018, when he started with Chipotle Mexican Grill, over the next 7 years, the Chipotle stock went up in value about 1,000%,
wow.
and their profits increased 600%. And we think there's a similar setup to Starbucks, maybe not quite the same leverage. It's obviously a more mature company, but he's doing all the right things, we think, in terms of improving throughput, which will drive sales. Trying to bring back that Starbucks coffee house vibe that we knew and loved from the old days. And I think most surprisingly, he still sees opportunities for another 10,000 locations in the United States alone. And so really, it's just a case of betting on a management team that has done this before, betting on a CEO that's turned around a company adjacent to Starbucks in the same space, and letting him do his thing.
Okay, he's taking stuff off the menu as well, so we'll see how that goes. We're slashing it by 30%, so
yeah,
we'll see.
It's all comes down to, again, bringing throughput, making easier operations, and improving the margins, and we'll see how it pays off. We think we trust what he's doing.
Got it. All right, let's go to your next pick, which is Amazon. Amazon, of course, has done really well. I'm just wondering what you see ahead for them.
Yeah, so Amazon, it's been a great performer the last couple of years, benefited from this growth in generative AI. But, Amazon, we just see this as a dominant retail company. I think they recently surpassed Walmart as the largest retailer in really around globally. And we see this continuing. They continue to invest in faster delivery, increasing Prime membership and more benefits to Prime members. And we still think it's relatively early days in this company's life cycle. And so we see the company continuing to grow earnings and profits very strongly, taking market share. Their AWS business is really a small oligopoly with Microsoft and Google and the hyperscaler business. And ultimately, it's still only earning net margins of around 10% on the bottom line. And we think those can double over the next 6-7 years to 20% and potentially even move higher. And so this is a company that we think revenue growth, sales growth, they're in all the right areas. They're leaders in the space. And stocks pulled back about 15% in the last couple of weeks, and it's a good time to revisit it.
Yeah, buy with the 78 position there. Okay, let's go to your third pick, which is Kering, which is a luxury brands company.
Yeah, so Kering is a luxury goods company. They're the owner of Gucci, Yves Saint Laurent, Balenciaga, among other sort of luxury products. And the luxury market's just been weak coming out of the COVID boom that we saw a couple of years ago. China's been a big culprit of that. The Chinese consumers really pulled away. And Kering's had some issues with their Gucci brand, and that just wasn't resonating with consumers. China, again, was a big part of that. They had a designer in there that was trying to sort of elevate the Gucci brand to be more, a little bit more like maybe Louis Vuitton, more leather goods, more classic fashion. And that's not really what Gucci's about. Gucci's usually a loud, more outrageous brand in the luxury world. And so we didn't think that strategy was working. They've moved now to a new designer, or they're going to be moving to a new designer. That gives us some upside, we think, in terms of Gucci being a brand that twice before has been left for the dead and then had a huge resurgence. We think that's a possibility. But longer term, we just like the luxury space. It's generally pretty heavily, very stable business, a bit of a monopoly between the different players involved. And it's a company, it's a brand or a company that should trade at a mid-20s PE ratio, we think, in a more of a normalized luxury market when their operations are clicking. And it's just trading around, I think on a forward basis, just around 17, 18 times. So lots of room for that multiple to go higher as they turn the company around. And really, it was just Gucci that was dragging it down. I've just a few seconds. Yeah, Gucci was the main problem. Its sales have fallen from about $10 billion a year down to $7.5, $8 billion. But certainly some of their other luxury products as well have slipped in the last couple of years. But the other part too is they have a nice real estate empire underneath all this that really secures these locations for the long term.
Great. Jamie, thanks for coming in. We're running out of time, but I appreciate you coming in and sharing your time. We are calling it on this show. We'll see you again tomorrow. Thanks for watching.